True bull markets in gold and gold stocks don't come along very often, but when they do, playing them well can be financially life-changing. These are the principles that can help you succeed. My name's Garry Davis, and this is general advice only in this presentation. There's my licensing details, and just a reminder that we may or may not own stocks that are covered in this particular video. All right, what to expect from a bull market in gold? They tend to run for long periods is the first thing. They don't come along very often, but they tend to rise further and faster than just about any traders expect. But along the way, gold and silver stocks are highly volatile, so care is needed, a well thought out plan is needed. Gold stocks also tend to outperform the underlying metal because of the leverage of having fixed costs and a rising price. So you can get more leverage in trading gold stocks than you can just in trading gold itself. The factors that are most important in the selection of the gold stocks, because it's not a situation where the same tide rises all boats. It's very stock specific, and these are the key factors that you should be looking for. First and foremost, with developers of gold projects, you really need management that has got a track record, they've got expertise, they've got success in the past, because those people tend to do it over and over again. Next, the size and grade of the resource is important, and or the blue sky potential, particularly in a true bull market. Traders tend to favour stocks that have got the real blue sky potential, where no one knows where the limits are, and they tend to get favourable treatment in the market. Another important factor is the proximity to infrastructure. If the resource being developed is close to all the infrastructure needed, roads, rail, gas, electricity, water, all those sort of things, then the cost of infrastructure is more easy to deal with. The stage of development is important because project lifestyles can span over 3 to 6 or even 8 years. So the stage that the stock is at, whether it's very early stage, whether it's just the first discovery has been made before any sort of resource definition has occurred, or whether it's closer to completion of construction and commissioning, as important. And of course, once in production, then what is the size of the gold resource? And that leads to the not the final point, but certainly another key point is that particular gold stock of appeal to bigger producers that might want to acquire them? Because often you'll see in gold bull markets that there'll be an acquisition premium baked into a smaller gold stock share price, before that event happened, and that premium may exist in that stock for a year or two. Now, the most important thing is to devise a plan. You can't expect to make money effectively in a gold bull market just by turning up and buying a couple of gold stocks. So these are the things that I think are really important in devising a plan. First of all, decide what percentage of your portfolio you want to allocate to gold stocks. Is that 5%? Is it 10%? What is the percentage? And it needs to be in balance with other megatrends in other commodities, or it could be in healthcare, or it could be in any other areas of the economy. So first of all, decide what that percentage is and just keep it in balance with everything else that you're doing. The next thing is to just double check that the sector fundamentals are conducive for a bull market. Sometimes the circumstances are just not in favour of a bull market. Such if the US dollar is rising strongly, that's not a good environment for gold stocks. The next thing to do is to look at how many stocks you want to manage in that particular part of your portfolio. Is it 2 or 3, or is it 6 or 8? So again, you can make that decision before the event. And you consider things like market cap. Do you want to own more large cap, or are you okay with smaller cap stocks? You want to look at the volatility. The larger stocks tend to be less volatile. And you also want to look at the risk level. The earlier stage you go, there is the potential for a much greater return but there is also much greater risk. The next thing to consider is what relative balance do you want between producers, advanced developers, or early stage developers. So all these decisions can be made before you start. And then we need to get to the activity of developing a watch list of quality candidates. Now, even early stage developers can be described as quality candidates because they may have already defined a very, very significant world scale resource. I think you need at least 2 to 4 times as many stocks as you intend buying. So if you intend buying 4, then have 15 stocks on your watch list. Because the one thing you don't want to do is to chase prices on your favourite stocks. Have a big enough watch list that you can sit back and just wait for the stocks to come to you on your terms. Identify sound entry levels and just let the prices come to you. Now let's look at a couple of charts. We'll start with the gold chart going back to 1990. So from October 2004 to August 2011, which is when the gold market came out of basically 20 years of going sideways. And it rose by $1,476 from the breakout point to the peak in August of 2011, or 440% was the overall gain. We then had a significant bear market in gold from September 2011 to December 2015. And then the next bull market effectively started. Took a little while to get going. It was really 2019 before it really got underway. And we then went up another $700 or 44%. So they're the two significant bull markets in gold over the last 2 decades. If we look at the HUI index, which goes back much longer than some of the newer gold indices, so looking at the actual what its stocks do themselves, and bearing in mind this is basically what the larger cap producers were doing. This doesn't really reflect what small cap stocks were doing. So from October 2004 to August 2011, the index gained 263%, and many stocks did far, far better than that. From May 2019 to August 2020, there was a further 61% gain. But look, throughout these periods, and I've been buying and selling gold stocks for nearly 3 decades, many stocks were 10 baggers, 20 baggers, even 30 baggers if you got in early enough. So the potential to make really seriously big returns is certainly there. Just to look at a couple of examples, and these not recommendations, just examples of price movements in gold bull markets. This is Newcrest Mining, which is Australia's largest gold miner. And between July of 2003 and January of 2008, it gained 515%. And that is a large existing producer. From February 2015 to July 2019, it gained 285%, which was this move from here to here. So when they get going, these stocks go through very extensive periods of price gain. If we look at one of my favourite stocks, Northern Star, from 2011, it was broke out sitting around about 50 cents, made it all the way to $17 at the top. Now this price rise was not just about a gold bull market. This was about an exceedingly well managed company that that grew by acquisition, that grew by expert drilling, and just basically building their resource. But again, that's a 30-plus bagger stock. And just one final one to finish in America. This is a stock called Eldorado Gold, and you can see that we saw a price rise there from around $10 to well over $100. So another 10 bagger. All right, there are also risks, obviously, in being in the gold market. Just to frame some of the risks of investing in gold producers and gold developers, the ability to raise capital and to explore has got to be considered, because sometimes it's relatively easy to raise capital, and other times it's quite challenging, and gold producers and gold developers can find it extremely difficult trying to raise capital. So that's something that always needs to be considered. From a project point of view, the availability of a skilled workforce and the ability to develop the project is critical, because it's not just a matter of finding a resource. You've got to have the people, and you've got to have the infrastructure, and you've also got to be mindful of inflationary cost blowouts as well. If it's a period of higher inflation, which tends to be good for gold, then just the costs of constructing the project can cause problems. There are ways to reduce the risks, of course, and some of those are only by proven quality assets. Don't work off speculative tips that you might have heard somewhere. Make sure that what you're buying into has the potential, or already is, a world-scale class quality project. Ensure that management has a great record of success, because good management tends to produce success over and over. Buy when undervalued. Don't buy into the hype. Wait until prices cool off and sentiment cools off a little bit, and you can amplify your ultimate returns very significantly by doing that. So what is your plan? I favour an approach of building a core position. If it's a quality asset, build a core position that you intend to sit on for several years, but keep the size of the position modest enough that you can accommodate the volatility over the years that will go along with that. So you can determine what percentage of your portfolio that is in advance. And then build around that trading portions of how to enter and how to take a profit, how to enter on weakness and how to take a profit. What are the signals that you look for? And then most importantly, those first two things are obviously vital to do, but there are periods where gold stocks just go through either a significant retracement, or they might just go flat for a while and the market just gets bored with them. And it's easy to lose sight of the emerging opportunity. So how will you stay on top of it? Being able to monitor it when the sector is in drawdown, because sometimes those drawdowns can be 3 to 6 months. How do you resist the temptation to be distracted by the next thing, the next shiny object that the market is trumpeting at the time? It's important to understand and use the development price cycles around a project. And I don't strike many people that actually understand the diagram that I'm about to show you. And this is a typical lifestyle of a mineral discovery. So it applies to gold or copper or lithium, whatever it might be. You get a lot of enthusiastic speculation when the discovery is first made, and the price can go up many, many multiples of where it was. But then the company has to get down to doing all the hard yards, doing the drilling, defining the resource, getting all the approvals, getting finance, all those sort of things. And that can take several years. And during that period, we see the price generally decline, and sometimes decline quite substantially. 50% declines would be absolutely normal, and 80 and 90% declines are not uncommon before the project starts to get to the point where it's effectively de-risked and they're getting close to production. And then the price can take off again. So understanding this price cycle and where you are in the cycle is absolutely critical to doing well in a gold bull market. So if you want to know more, the Sunday YouTube videos that I produce, if you can subscribe to that channel, because gold and other precious metals get airplay every week. Their videos also include a comprehensive market overview and perspective. I've been in the market 35 years. I've been trading gold stocks for 30 years. And, I don't have any particular allegiances. I'm a completely unbiased financial advisor. It doesn't matter to me whether gold stocks are going up or down, but I like it when they're going up. Beyond that, Portfolio Analyst, which is one of our services, has a $1 trial, and gold stocks are recommended and reviewed in that service regularly. And then there's the Insiders Club, which is our flagship membership service with specific entry and exit advice, and also high-level support from me. So we're here to help you make your share market journey more successful.